Home prices in Austin have crashed by nearly 20%, the sharpest drop of any major city in America. And in some neighborhoods, values have plunged over 34%. But here's the thing. When a market falls this hard, seasoned investors know it's time to start paying attention. So, is this Austin's bottom? Or is there another leg down coming? As someone who's tracked this market for over a decade, I can tell you, what's happening in Austin right now feels eerily similar to Silicon Valley in 2009. Back then, the headlines screamed panic, and those who acted early walked away with massive gains just a few years later. In this video, I'll break down the exact zip codes where smart money is starting to move in, show you which areas are still dangerously overvalued, and explain why 2025 could offer some of the best buying opportunities we've seen in a decade. And trust me, if you're investing from the US, UK, Australia, or Canada, you're going to want to see these numbers. Stick around. 1. What's really happening in Austin? Right now, let's cut through the noise. Over the past 2 years, Austin has seen a nearly 20% drop in home values, making it the hardest-hit major housing market in the US. And while the media headlines paint it as a straightforward crash, the reality on the ground is a lot more complex. And honestly, a lot more interesting. For example, take zip code 7874 in Southeast Austin. I was recently speaking with a local investor, Sarah, who picked up a 4-bedroom home there in late 2020 for just over $615,000. Today, that same home is struggling to fetch $410,000.
That's a 34% decline, and it's not an isolated case.
Now here's where it gets fascinating. Inventory in Austin has exploded. Back in early 2021, we had 3,600 active listings across the metro. As of this quarter, we're looking at over 10,000 homes sitting on the market. Take a look at this chart. Austin housing inventory growth, 2021 to 2025. And it's not just the raw numbers. Homes are sitting unsold for 2 months or more compared to just 4 weeks before the pandemic. The supply-demand equation has completely flipped. What does this mean? In simple terms, Austin has shifted from a seller's market to an extreme buyer's market, and smart capital is quietly paying attention. 2. Why Austin 2025 is not another 2008. Now, I know what some of you might be thinking. Is this just another housing crash like Vegas or Phoenix in 2008? That's a valid question. But no, Austin's fundamentals are very different this time around. First, population growth. Despite the headlines, Austin continues to attract tens of thousands of new residents annually. Many of them are high-earning professionals, particularly in tech and healthcare. Tesla's Gigafactory, Apple's billion-dollar campus, and Oracle's relocation have cemented Austin as a major player. Take a look at this chart. Austin population growth versus housing inventory, 2015 to 2025. And here's an insight you won't hear on the news. Wages in Austin are up, even as housing prices have dropped. According to recent data, median household incomes in the area have risen by 8% over the last 2 years. That's the kind of income growth you want to see if you're betting on long-term rental demand or future appreciation. I was recently at a real estate roundtable in New York, and one of the analysts compared Austin 2025 to Brooklyn in 2012. Back then, everyone thought prices had peaked. But those who bought during the uncertainty saw double-digit annual appreciation within a few years. The takeaway? While Austin's market correction has been painful, it's also setting the stage for the next growth cycle. 3. Where are the real opportunities? Now let's get into the nitty-gritty. Not all areas in Austin are equal. Some have overcorrected. Others still have room to fall. Travis County, which includes downtown Austin, has seen prices drop significantly. 2 years ago, it was 40% overvalued. Today, that number has come down to 11%, and we're seeing the market inch closer to fair valuation in key neighborhoods like Brentwood. Zip code 78756. Prices there have already dropped by 20%, and they're now only 10% overvalued, a signal we're close to the bottom in that area. Check this out. Brentwood overvaluation rate, 2021 versus 2025. By contrast, Williamson County, home to Round Rock and other northern suburbs, is still 16% overvalued. And Hayes County in the south isn't far behind at 11%. But here's where I'd be cautious. Fredericksburg, located in Gillespie County, is currently 23% overvalued. Prices there have remained sticky, partly due to its appeal as a wine country getaway. But based on current income-to-price ratios, we could still see another 20% correction there before hitting fair value. As an investor, you need to ask, am I looking for long-term capital appreciation? Do I want immediate rental yield? If it's the latter, focus on areas near major employment hubs. The Domain, for instance, has seen price drops but remains attractive because of its proximity to tech campuses and a highly skilled workforce. 4. What smart investors are doing right now. I've had conversations recently with several clients from London and Sydney, savvy investors who are tired of thin margins at home and are eyeing the US for higher yields. Austin is high on their radar. But they're not just throwing darts at the map. They're using data-driven strategies, analyzing zip code-level overvaluation rates, rental demand indicators, and days on market. For example, one client recently bought a duplex in East Austin for $500,000. It had been on the market for 90 days, and the seller was motivated. With minor renovations and a strategic rental plan targeting remote tech workers, he's now pulling in a 7% net rental yield, far above what you'd see in places like London or Vancouver right now. Here's another critical factor: interest rates. While rates are still relatively high, there's growing consensus that we'll see cuts by late 2025, which could reignite buyer demand and push prices up again. If you wait until rates drop and the headlines turn positive, it's too late. The deals are gone by then. The smart play is to buy before the crowd, when the data signals stability but fear still holds others back. 5. How to identify the bottom and when to move. So, how do you know when Austin has truly bottomed out? Watch for 3 things. 1. Declining inventory. When the number of homes for sale starts shrinking consistently over several months. 2. Days on market falling. When properties start selling faster, even without major price cuts. 3. Stable or rising rents. If rents are steady or climbing, demand is returning. Take a look at this chart. Austin days on market trend, 2023 to 2025. At the moment, we're not quite there yet. Inventory remains high and days on market are still elevated. But in specific pockets, like Brentwood or parts of central Austin, we're seeing the early signs. From my experience, this window doesn't stay open long. If you're waiting for perfection, you'll miss it. The goal is to buy when the fundamentals make sense, not when it feels easy. 6. Strategic timing. Why acting early matters. Let me share something I learned the hard way during the 2011 downturn in Miami. Back then, I waited for every single metric to align perfectly before making a move. I wanted certainty. But by the time things felt safe, the prices had already jumped 15%, and all the best deals were gone. Austin in 2025 feels a lot like that. You won't get a formal announcement when we've hit bottom. No one rings a bell. What you will get are early signs, like what we're starting to see in areas like Brentwood and parts of central Austin. And here's a key insight. Investors who buy just before the rebound typically outperform those who wait. Take a look at this chart. Price appreciation post-crash, Austin versus Miami, 2010-2020. Those who entered early in Miami after the crash saw annualized returns of 12 to 15%, compared to latecomers who settled for half that. In my experience, what separates professional investors from casual buyers is this. Pros look at data trends, while casual buyers focus on emotions and media narratives. 7. How to approach Austin if you're investing from abroad. Now, if you're watching from the UK, Australia, or Canada, you might be thinking, why Austin and why now? Well, let's compare. In Sydney, average gross rental yields in prime areas hover around 3%. And that's before factoring in taxes and maintenance. In London, you're looking at 2.8% in central postcodes. But in Austin, certain neighborhoods are offering net rental yields of 6 to 7%, and that's on discounted properties with real potential for appreciation over the next 5 to 7 years. Check this out. Average net rental yields, Sydney, London, Austin, 2025. Plus, the regulatory environment in Texas is landlord-friendly, and there's no state income tax, which makes the math even more compelling for international investors. One of my clients from Melbourne recently told me, I never thought I'd buy property in Texas, but after seeing the numbers, I realized Austin offers better fundamentals than most cities back home. And he's not alone. So, let's take a breath and recap the big takeaways from today's breakdown. First, Austin's housing market has already corrected by nearly 20%, with certain areas seeing declines over 30%. Second, while some neighborhoods still have room to fall, others, like Brentwood and Central Austin, are approaching fair value, presenting potential early entry points for smart investors. Third, rents are holding steady in key locations, and with future interest rate cuts on the horizon, we could be staring at the early stages of a new growth cycle. If you're an investor from the US, UK, Australia, or Canada, and you've been sitting on the sidelines waiting for clarity, this is your early warning signal. The fundamentals are shifting. The data is there. And history has shown us time and time again, when fear dominates, that's when opportunities are greatest. Now I'd love to hear from you. Which areas in Austin are you watching? Are you already investing, or are you waiting for more signs? Drop your thoughts in the comments. I respond to every single one, and I'd love to discuss strategies with you. And if you found value in this video, here's what you need to do next. Like this video so we can get it in front of more investors like you. Subscribe to EstateScope because I release data-driven breakdowns like this every single week. And don't wait until everyone else is rushing back into the market. By then, the best deals are gone. This is James, and you're watching EstateScope. See you in the next one.